Trump's social post about repositioning nuclear subs, all giving stocks a hard time today. S&P on pace for its worst day since May, but my next guest recently went overweight equities and has a year-end target up 10% from here, 69.50. Joining me now is Marko Papic, macro and geopolitical strategist at BCA Research. Marko, put this in perspective for us. It can be easy to get caught up in the moves of the day. Why do things look perhaps brighter to you?
Well, first of all, we've been on a tear since May. May of this year returned the best S&P 500 performance since 1990. So everybody should understand that pullbacks obviously make sense on a very tactical time horizon. But over the next 6 months, I think that there is more upside to stocks for two reasons. That AI capex boom seems, like it's not going to end anytime soon. Probably it's going to end in tears eventually, but I don't see it ending over the next 6 months. And the second issue is that the Fed now has more than enough reasons to move into a firmly dovish stance and position. And I think it's going to probably surprise people by how dovish it's going to be, whether Jay Powell has a change in heart due to political pressure from President Trump, or whether President Trump's eventual shadow appointee starts flagging more support for the economy.
Marko, were you surprised by President Trump's EU trade deal and the 15% rate? What does that mean for U.S. markets and global markets?
So, no, I was not surprised. I mean, that was my view since really last March, before he was even elected, that eventually we would have these what I call made-for-TV trade deals.
Why do you call it that?
Well, I call them that because they're not comprehensive trade deals. So remember in April when he announced that there would be these very high tariffs, but then he was going to negotiate deals, and a number of trade negotiation experts came on your show and said it was impossible to do deals in such a brief period of time. That's because they lack imagination and a correct framework for analyzing President Trump, which is that everything is kind of a reality TV show. So these are not trade deals in the sense of what we consider trade deals from the past. They're really just framework agreements to build on. And so, yes, I expected that we would have these deals. President Trump loves deals. He said himself he's a deal junkie.
But to be clear, you see these deals as real, right? These frameworks, the 15% rate, what some people see as being lopsided and advantage in favor of the U.S. And the details will take a while to work out, but the market is right, it sounds like you're saying, to react the way it has to them.
Well, not necessarily. I mean, the market's been reacting all year to the trade deals. And of course, the dollar is down on the year. It's rallied over the last couple of days and weeks. And also, Europe has largely outperformed the U.S. since the beginning of the year. So let me explain what I mean. The first order takeaway from these deals is that the U.S. won and Europe lost. But that would assume that Europeans are just going to shrug their shoulders and say, oh, zut d'alors, I guess we're just going to have to take this 15% without stimulating domestic economy, without doing structural reforms. And that's obviously not my view. So investors would do much better to move away from the percent target and figuring out what it means and start to think of what are the consequences of these tariffs on other large economies, whether it's Europe, China, Canada. The rest of the world is not just going to sit on their hands and not respond. They are going to respond, not retaliating against the U.S., but by boosting domestic growth through fiscal policy. And the rest of the world actually does have fiscal space, unlike the U.S.